Hi everyone, it's Grace. Welcome back to my channel. So I hope you all had a great 4th of July holiday weekend. So the housing market is getting super hot entering the third quarter of 2021. But a lot of you may be wondering, is it going to crash anytime soon? This is a key question because once the bubble bursts and the housing price drop immensely, it will be the optimal time of doing investment. So today I will delve into this question by looking at some important data to figure out what is the current situation and what may happen in the near future. Before we begin today's video, remember to subscribe to my channel and click on the bell button so you get notified when new videos are out. Also feel free to give a thumbs up if you find this video useful. In last week's video, I mentioned that the inflation rate currently is at 5%, according to the US Bureau of Labor Statistics. To check out that video, click on the top here. Normally, a low inflation rate should be no more than 2%. And imagine, we're already at a wacky 5%. And this is the highest inflation rate since the 2008 financial crisis. Since the inflation rate drives up the prices of everyday goods, necessities, and housing, more and more people may be pushed to not being able to afford rent, mortgage, and pay off debt. If the already high inflation rate continues to rise, it can be a trigger for the housing market crash. Number 2. Unemployment rate. Besides inflation rate, the second most important data is the unemployment rate. Obviously, the COVID-19 pandemic has an immediate effect on the unemployment rate in 2020, but the effect hasn't gone away yet. According to the data provided by the US Bureau of Labor Statistics, on July 2nd, 2021, the unemployment rate is currently at 5.9%, which is 9.5 million people. In comparison, the unemployment rate in the pre-pandemic era was at 3.5%. What is not helping the situation is that unemployment benefits are still being provided, besides the fact that many industries are facing shortage of labor supply. For example, Florida continues to provide a supplemental $300 per week of unemployment benefits. I'm not saying that unemployment benefits should not be provided, but when two opposite situations occur such as this, the policy is not really helping to increase employment. When we combine a high inflation rate and high unemployment rate, it is a sign that the economy is heading towards a period of stagflation, where the inflation and unemployment are rising at the same time. And stagflation could lead to deeper debt crisis and an economic depression. Number 3, forbearance rate. The forbearance rate is an important indicator of the health status of home ownership. According to the data provided by the Mortgage Bankers Association on May 10, 2021, the national forbearance rate is currently at 4.36%, which is 2.2 million homeowners. While the forbearance rate slightly decreases over the prior week, the eviction forbearance moratorium is further extended to prevent foreclosure. However, the government policy is not really helping the situation. Because while homeowners can delay mortgage payment, it does not make it go away. They eventually have to come up with a larger balloon payment at the end of the forbearance period, or risk foreclosing the home once the period is over. For those that cannot come up with such balloon payments, foreclosure might be the only way out, and this will eventually drive down the housing market. Number 4, housing price. The housing price is currently at the highest since 2005, according to a report by S&P Core Logic on July 6, 2021. The year-over-year growth from May 2020 to May 2021 is at 15.4%. At the current trend, the housing price might be at its highest increasing point because more and more buyers are not able to afford anymore. The same report shows that 33% of the consumers exit the buying pool, while 82% say that the housing affordability is a major issue. The fact that the price is at an all-time high suggests that the housing market could plummet anytime soon so that it can rebalance the supply and demand. Number 5, primary mortgage rate. The primary mortgage rate is an important data that shows the dynamics of the housing market. What differs the mortgage rate from the housing price is that it is a government policy that influences the housing price. Currently, the 30-year fixed mortgage rate is still under 3%, which is used to stimulate more demand. However, because the price is at an all-time high, less buyers are motivated to take out more loans just to purchase a property. The sustained low mortgage rate may increase the debt crisis, because it inflates the debt that average household carries. When households are no longer able to pay off the debt, they might choose to sell their homes for settlement, which drives down the housing price. Number 6, lenders' expectation of refinance demand. The last but most important sign for a housing crash is the lender's expectation of refinance demand. There are many types of refinancing. It could be a cash-out refinance to free up more home equity so that homeowners can use the money to either buy a second property or meet other purposes. Refinancing also happens when homeowners find a lower mortgage rate, consolidate multiple mortgages, or transfer from an adjustable to a fixed mortgage, etc. So as you can see, there are many benefits to refinancing. But whatever the reason is, as long as there is a demand, there is a supply. But according to a survey by Fannie Mae, lenders' expectation of all kinds of refinance demand dropped significantly from 52% in the first quarter to 69% in the second quarter of 2021. And there's a reason for the drop. As home equity increases, people can take out more cash through refinancing, but lenders are less optimistic about making a profit and decrease the default and bad debt rate, since overfinancing may drive people carrying too much debt and not being able to pay off. So from the lender's expectation, we can also see that the housing price may drop immensely very soon. So these are my opinions about the housing market crash. What do you think? Comment down in the section below and let me know. I hope you find today's video useful, and I'll provide all the links to the data in the description below. In the next video, I will dig deeper into the Florida housing market for those of you who are looking to invest in this market soon. So stay tuned. As always, thank you very much for watching, and I'll see you on the next one.